So this is that article I want to do. Alistair McLeod's gold outlook for 2020 on Zero Hedge, although he does have goldmoney.com where this originally came from. So maybe I'll go there for you. I'll go right to the source. How about that? Goldmoney.com. Goldmoney.com. This article is an overview, although, again, it's quite long, is an overview of the economic conditions that will drive the gold price in 2020 and beyond. The turn of the credit cycle, the effect on government deficits, and how they are to be financed or addressed. And he covers a lot of that in the beginning, and then at the end kind of gets into the gold part. So just bear with me, because it almost sounds like, well, it doesn't have too much to do with gold just yet, as he talks about some of the stuff. But it does. You'll see. In the absence of foreign demand for new U.S. treasuries, and I just talked about this in my last video and the one before that, the U.S. treasuries, the Federal Reserve cannot buy them directly. Not allowed. It's against their charter. It's illegal. So they let the banks that they've always bail out buy them, wait 3 days, and then the Fed buys it from the banks with interest. They make millions of dollars in interest. That quick. Boom. Thank you. Anyways, in the absence of foreign demand for new U.S. treasuries and of a rise in the savings rate, the U.S. budget deficit can only be financed by monetary inflation. This is bound to lead to higher bond yields as the dollar's falling purchasing power accelerates due to the sheer quantity of new dollars entering circulation. The relationship between rising bond yields and the gold price are also discussed. It may turn out that the recent extraordinary events at the COMEX, which is the place where gold and silver paper garbage future contracts are traded, with the expansion, so it may turn out that the recent extraordinary, and you say, what do you mean, what extraordinary events? I haven't really heard much. Well, I guess he's going to get into it. Extraordinary events at the COMEX, with the expansion of open interest failing this time to suppress the gold price. So that's the extraordinary event. Normally, what is open interest? Is that like an interest rate? No, open interest typically means how many contracts. Paper contracts, who's betting long, who's betting short. And typically when those contracts, open interest explodes, a lot more contracts. Again, without any more gold to back them, just print more. When that happens, typically, here we go, price gets dumped on. This time it didn't happen. Now, granted, it's Sunday, January 5th, 2015. The gold price, goldprice.org for the quickie, $1,552. Now, again, this is the weekend, so it doesn't really matter. The trading has stopped. The prices are stale, if you will. Gold got to, I see, 1553 was the high, looks like. And this would have been basically Friday before market close. And the high of silver was $18.26. It came down to about $18.05 for the day. It was up about 0.5%, it looks like. Every time we see, recently, silver getting to the 17s, it got smashed back down. Again, the open interest, a lot more contracts, market goes down. That didn't happen. So why I'm saying this is, well, Monday, you're going to see this video tomorrow morning. The market's open either at 8 or 8:30 a.m., I forget. I believe on Monday. Or technically, though, the futures, like the pre-market, opens Sunday night. But anyways, it'll be interesting to see how this week goes. If this whole week goes by and they stay even flat but don't drop, this may have more relevance than you think, is what he's saying here. And we might be seeing $19, $20 silver. Oh my God, $22. Holy crap, $25. Are we going to see the web bots $600 silver? Again, not that fast, but the path to it, we've been waiting years for it to at least start. Okay, it's starting. Is that about to happen? I don't know yet. We're going to find out. And I will remind you, this has been in data from in the Webbot for a long time, and it has come up over and over and over again. And when Cliff High says that happens, it is baked in the cake. It is going to happen as far as he's concerned, based on how his thing works, his Webbot. If it keeps coming up over and over and over and over and over, it's like it's going to happen when, I couldn't tell you, but it's going to happen. And it said it would start with oh my gosh, silver is up $2 in one day. in a 24-hour period. Whoa, we've never had that happen. Like, oh my gosh. And then it would be a $5 a day move. Oh my God, and again, doesn't mean it went up $5, but it might have made a move up and back down or whatever, but basically a $5 move. That also means it could explode higher and then the next day explodes lower. Oh my gosh, it's down $4 today. It's just saying moves like that are coming. Unprecedented moves like that have never come like that are coming. So, and this is for my two buddies. You come yet? That is a very inside joke that they might know about. So, actually, maybe even Bill remembers that one. So it was $2 a day moves, $5 a day moves, $20 per day moves following. Again, at some point. But he said, when we're there, when you start seeing the $2, then the $5, it's coming, and it ain't going to be too awfully long. So could you imagine if an item right now, silver, that is $18, what price could it be in order for it to make a $20 move in a day? Either up or down. If it's $20, do you think it's going to move another 20 and go up 100% in one day? In all fairness, probably not. That's like cryptocurrency. No. This isn't crypto. No, it doesn't do that. However, what if the price of silver is 100 or 150, 160 bucks? 160. Could it move $20? Oh, sure. At that point, I would say, it'd be kind of common to see a move like that. It wouldn't be too outrageous. Hey, silver moved 15% today, okay. So that's my, monkey mind opinion, whatever you want to call it, on that. So do keep that in mind, that this has been in the Webbot data for a really long time. And maybe we're about to see this finally start going. And I thought not too long ago we had it was either almost or it was like a day and a half we had a $2 move or something like that. Someone had sent it to me. I was like, oh, we're getting close. But it was like a one-off, right? So anyways, it may turn out that the recent extraordinary events on the COMEX, with the expansion of open interest failing to suppress the gold price, and silver too, are an early recognition in some quarters of the U.S. government's debt trap. The strains leading to a crisis for fiat currencies are emerging into plain sight. Introduction. In 2019, priced in dollars, gold rose 18.3%, and silver 15.1%. Or rather, and this is the more relevant way of putting it, priced in gold, the dollar fell 15.5%, and in priced in silver, 13%. This is because the story of 2019, as it will be in 2020, was of the reemergence of fiat currency debasement. Particularly in the last quarter, 2019, the Fed began aggressively injecting new money into a surprisingly illiquid banking system through repurchase agreements, whereby banks' reserves at the Fed are credited with cash loaned in return for T-bills and coupon-bearing treasuries as collateral. Furthermore, the ECB restarted quantitative easing in November, and the Bank of Japan stands ready to ease policy further if the momentum towards its 2% inflation target comes under threat. The Bank of Japan is still buying bonds, but at a pace which is expected to fall beneath redemptions of its existing holdings. Therefore, we enter 2020 with money supply being expanded by 2, possibly all 3, of the major Western central banks. Besides liquidity problems, the central bank's nightmare is that the threat that the global economy will slide into recession, though no one will confess it openly because it would be an admission of policy failure. And policymakers are also terrified that if bankers get wind of a declining economy, they will withdraw loan facilities from businesses and make things much worse. But Trump's in the house. And when he asked the Fed, don't be raising those rates anymore, the Fed, okay, neutered. Oh, all right. Yeah, we're probably going to raise. No, we're not. So we might start going lower and lower and lower. So some of this might not quite be what he thinks. However, the overall picture, I think, is accurate. Of the latter concern, central banks have good cause. And again, I'm just talking our country. What about those other 2 economies? What about Japan and the EU? They may not be following suit like we are. They've already gone, many of them have already gone negative. I was reading the other day, you could get a mortgage rate. I thought it was in Britain somewhere. 1%, like a 1% rate or somewhere over there. What? Can I have a 1% rate? Do you know how fast I'd refinance this house? At 1%? Are you kidding me? Exactly. So of the latter concern, central banks have good cause. A combination of the turn of credit cycle towards its regular crisis phase in Trump's tariff war has already hit international trade badly, with exporting economies such as Germany already in recession and important trade indicators such as the Baltic Dry Index collapsing. That's a shipping index, basically. No doubt President Trump's most recent announcement that a trade deal with China is ready for signing is driven by an understanding in some quarters of the White House that over trade policy, Trump is turning out to be the turkey who voted for Christmas. But we have heard this story several times before. A forthcoming agreement announced only to be scrapped or suspended at the last moment, which is true. But again, we have all the cards. Trump has the cards. China doesn't. They've all been taking advantage of our country all these years, under Obama especially, but before then too, which would have been Bush, and before then too, which was Clinton, and it got really started under Papa Bush before Clinton. So we have nothing to lose and everything to gain. China and everybody else, trade-wise, you guys have everything to lose, not us. The subject which will begin to dominate monetary policy in 2020 is who will fund escalating government deficits. At the moment, it is on few investors' radar. But it is bound to dawn on markets that a growing budget deficit in America will be financed almost entirely by monetary inflation, a funding policy equally adopted in other jurisdictions. Furthermore, Christine Lagarde, who is now the new ECB president, European Central Bank president, she left the IMF, I'm going to work over there now, has stated her desire for the European Central Bank's quantitative easing to be extended from government financing to financing, well, environmental projects as well. That's just another way to give their crony criminal partners, NGOs, climate change people, companies, we're going to help funnel more money into garbage where it goes nowhere. But anyways, it's another story. 2020 is shaping up to be the year that all pretense of respect for money's role as a store of value is abandoned in favor of using it as a means of government funding without raising taxes. 2020 will be the year when currencies begin to visibly get trashed in the hands of their long-suffering users. So my question to everyone, how's that going to affect cryptocurrency? How's that going to affect gold and silver? Well, I think he's about to talk about gold and silver, but if gold and silver are going to do this, I think cryptos are going to do the same. And Cliff I had emailed me and Bix a little while back, not too long ago, and he had just said, just a comment in an email about crypto and stuff, and has kind of left that alone. And he goes, and I'm kind of fine with that right now, because he goes, look, from 2020 to 2025, I think he said, anybody in crypto, like who's in there now, we're all going to be set. We're going to be set. So whether I talk about it anymore or not is really irrelevant. I know people want to hear me, what I have to say about it, but it's really irrelevant. If you're holding crypto right now, for the next 5 years, you're set, is essentially what Cliff had said. And this just makes sense to me. Even reading this helps that. So gold in the context of distorted markets. At the core of current market distortions is a combination of interest rate suppression and banking regulation. Let me stop for a second. Back to cryptos. They control the price of gold and silver, through paper contracts in the COMEX. But at any time, if any of us, any people out there decided, I'm going to go hit the COMEX and I don't want to play the paper game, I'm going to immediately demand delivery on my contract. Here's the rest of the money. Give me the gold, deliver it. If people did that, same with silver, you'd start taking the supply out. And if you took out enough supply, even with the rigging paper game, they wouldn't be able to suppress the price, because they wouldn't have enough supply to actually do it. But right now, anytime anyone asks for delivery, they could get it, but nobody does. It's just a paper game. No one seems to want the gold and silver. With crypto, well, they have futures contracts now, okay. But with crypto, you've got to own that damn thing. And there's only so many of them. So while even though the Fed and or the COMEX, everyone has some gold somewhere, this bank has some, whether it's lent out 5 times to 5 different people, whatever, there's still gold there. And they're still mining it. There's still more gold coming online. There's still more gold and silver coming online, so to speak, from being mined. What happens to Bitcoin? It can only be mined till there's 21 million. Litecoin, again, it's either 84 or 86 million Litecoin. And it gets harder to mine as you get closer to the end, which is happening. And again, we have the halving of Bitcoin rewards for mining coming up this year in a few short months. So that's essentially saying, oh, this gold mine dried up and this other gold mine dried up. Holy crap, world supply of gold has just got cut in half. That's what's happened. That's what that means with Bitcoin. And it doesn't mean it happens immediately. It happens as supply starts drying up. How long will that take? No one knows that. So I think cryptocurrencies could get quite explosive again, whether they try to clamp down on them now or not, which they are, but they can only do so much with what they've got. And at some point, the people wanting it will outweigh anything that they think they can do on these exchanges or any futures or anything. It won't matter because people will be signing up left and right to just buy their crypto. Thank you. Give me that. And again, with gold, I got a contract. Okay, well, you got a 5,000 ounce contract of silver. How we gotta get a Brinks truck? We're gonna send the Brinks truck. You could meet us over there and pick it up. Like, what are you gonna do? 5,000 ounces of silver for a futures one futures contract? What? How about I open my laptop or my computer up, turn it on, whatever, log into my account, the exchange, in other words, the COMEX. I go into the exchange, Binance, Coinbase, whatever, and I buy some crypto, futures contract, if you will, a futures gold contract. I'm demanding delivery immediately. I just bought 1 Bitcoin. I want it now. Thank you. And I transfer it to my wallet on my computer like that. I never left my house. Now delivery, you gotta, nope, done. It's so easy, and that's what people are doing. It will dry up. And I think when Cliff says from 2020 to 2025, anybody in crypto now is going to be really, really, really set and really happy. And I strongly agree with that statement. So wherever I was, at the core of the current market distortions is a combination of interest rate suppression and banking regulation. It is unnecessary to belabor the point about interest rates because minimal and even negative rates have demonstrably failed to stimulate anything other than asset prices into bubble territory. Yes. And I'm telling you, as Donald Trump's final, I'm pushing this economy for everybody, your housing prices before the whole thing falls apart. And I fixed the whole thing with this gold-backed thing we're going to do. I'm telling you, I think we're going negative in this country. It may be his second term. I'd love for him to start doing it this year as he gets close to his election time. And I say him, well, he doesn't set policy right. No, but he talks to the Fed, and the Fed appears to listen to him. And he's yelling and calling them names. Basically, he's a moron. The Feds don't know what the F they're doing. Whoa. Go get him, Mr. Trump. Great. So what if 6 months from right now, June, July-ish, oh, the Fed has gone down a whole point. Oh, my God. Mortgage rates are down a full percent, 4.2 to 4%. No, it's down to 3.0% is a normal average 30-year rate. Whoa. 2.8%? Oh, really? And they're playing this on the TV for his political ads. Look what the president has done. Talk about timing. Oh, James Comey's been indicted. Baker's nailed. McCabe's nailed. Oh, right before the election, like I keep saying, I think it's going to happen. There'll be nobody left standing on the Democratic side that will even come close to running against Trump. He will win in a landslide. And as my mom says, look out for Biden to step down. He will be stepping down. He'll either say it's something to do with a family member he has to step down because of that or some kind of illness or something like that. But that's what you're going to hear. She goes, I'm telling you, it's going to happen. Okay. And I've said this less than probably like 10 times now. Multiple videos. But there is a woeful lack of appreciation about the general direction of monetary policy and where it is headed. The stated intention is the opposite of reality, which is not to rescue the economy. While important from a bureaucrat's point of view, that is not the greatest priority. It is to ensure that governments are never short of funds inflationary financing guarantees the government will always be able to spend, and government licensed banks exist to ensure the government always has access to credit. Unbeknown to the public, the government licenses the banks to conduct their business in a way which for an unlicensed organization is legally fraudulent. The banks create credit, or through their participation in QE, quantitative easing, they facilitate the creation of base money out of thin air, which is added to their reserves. It transfers wealth from unsuspecting members of the public to the government, crony capitalists, financial speculators, and consumers living beyond their means. I guess that covers all of us. The government conspires with its macroeconomists to suppress the evidence of rising prices by manipulating the inflation statistics. As I've said before, the Federal Reserve used to look at this, macro data. We've got all these points of data to tell us what inflation is. We don't look at oil prices. We don't look at electricity. We don't, food prices. Whoa. The most important things you don't look at? No. And then when one of the things that they used to look at starts saying, flashing red, we've got a problem, they remove it off their list and they add something else. We're going to look at this now. This is our stuff we look at to see if there's any inflation that's going unnoticed, where we need to be with inflation. Kind of like the Dow Jones or whatever, these basket of different companies make up this big stock, and those two companies sucked. We got to remove them. We're going to put, we'll grab Apple and we'll grab Joe Schmo. I read the other day, 2 companies alone were responsible for the 20% rally in that market in 2019. 2 companies out of the whole basket was mainly responsible for 20% of the move. Anyways. So successful has this scheme of deception been that by fueling GDP, monetary debasement is presented as economic growth, with very few in financial mainstream understanding the deceit. The government monopoly of issuing money and through their regulators controlling the expansion of credit was bound to lead to progressively greater abuse of monetary trust. And now, in this last credit cycle, the consumer, who is also the producer, has had his or her income and savings so depleted by continuing monetary debasement that he can no longer generate the taxes to balance his government's books later in the credit cycle. The problem is not new. America has not had a budget surplus since 2001, the last credit cycle. And by the way, around 2001, I think we only had maybe $3 trillion in debt. 2 to 3 trillion, I think, when I just go off my memory, about 3 trillion. From the existence of our country 200 something years ago till now, we had $3 trillion finally by around 2000, 2001. Then we had the endless wars, more endless wars, banker bailout, everything else, and we are now over $22 trillion. Matter of fact, national debt. What is the exact? Do I have an exact number? U.S. debt clock, real time. It shows 23 trillion. U.S. national debt is 23.1 trillion, is what it's saying right now. And I've always said this: if that's the case, and it is, and the debt just keeps getting higher, we can't pay it off. We don't have the taxes. They can't raise them fast enough. Why, in God's name, are any of us paying IRS income tax? Why doesn't President Trump come out and say, you know what, I'm destroying this whole thing today, it's gone. It's done. I feel like maybe that might happen, I hope, when he announces the gold thing. Oh, we're going to fix this problem, we're going to get rid of the Fed, and we're backing our money by gold. The Fed's no longer needed. As the Constitution states, Congress shall set and set the monetary value of the dollar or what have you. Not a third-party Federal Reserve. And I can only hope, because we somehow got through this country up until 1913. Because, it's 16. 13 was when the Federal Reserve was created. 1916 is when the income tax law kicked in. We got to 1916. So, 100 years. A little more than that, actually, at that time. Well, let's see. Yeah, because you're talking 1816 to 1916. 100 years. 1776, revolution, a little over 100 years, the country operated fine without collecting an income tax. Isn't that amazing? The problem is not new. America has not had a budget surplus since 2001. The last credit cycle in the run-up to the Lehman crisis did not deliver a budget surplus, nor has the current cycle. Instead, following the Lehman crisis, we saw a marked acceleration of monetary inflation. And figure 2, which I don't know that you need to see it. I'll just talk to you, okay? Shows how dollar fiat money has expanded above its long-term trend since then. And this really started, it was very much neck and neck until about 1995-ish. It got held close till around 2000, 2001, 2002, and then, and now it's out of control. It's like, looks like a cryptocurrency spiking. You know, like, whoa, what is that? In recent years, the Fed's attempt to return to monetary normality by reducing its balance sheet, which I told you would fail when they announced it. I was one of the first people to come out immediately. This will never, they'll stop at some point and reverse it. This will never go on. They can't, because we have to keep creating more debt. This is a debt-based society. It will not function. Trust me. Sure enough, reverse. $5 trillion. Hey, we got down to $4.5 trillion. See, I told you, Jason, you know, not that the Fed would say that. They don't even know who I am. Told that idiot doing computer, you know, in his laundry room back in the day. My laundry room doing videos at moron. Doesn't even have a college education. We're the Fed. We have massive different, highly educated people here. You're going to tell us we can't reverse. We just took off $500 billion, son. We're down to 4.5. And now you're back up to where you left off. We're back to 5 and it's going higher. Thank you. After a brief pause, the fiat money quantity has begun to grow at a pace not seen since the immediate aftermath of the Lehman crisis itself and is back in record territory. Figure 1 is updated to November 1st, since when FMQ will have increased even more. In order to communicate effectively the background for the relationship between gold and fiat currencies in 2020, it is necessary to put the situation as plainly as possible. We enter the new decade with the highest levels of monetary ignorance imaginable. It is systemic. It's a systemic issue of not realizing the emperor has no clothes. Consequently, markets have probably become more distorted than we have ever seen in the recorded history of money and credit, as widespread negative interest rates and negative yielding bonds attest. In our attempt to divine the future, it leaves us with 2 problems: assessing when the tension between wishful thinking and financial markets and market reality will crash the system, and the degree of chaos that will ensue. The timing is impossible to predict with certainty because we cannot know the future, but if the characteristics of past credit cycles are a guide, it will be marked with a financial and systemic crisis in within one or two or more large banks. Liquidity strains suggest that that event is close, even within months, maybe even weeks. If so, banks will be bailed. Of that we can be certain. Now, I know Bix Weir, my pal Bix. The people will not stand for another bailout. They won't allow. Yeah, they will. Because there's nothing we can do about it anyways. We voted these people in. They represent us, and they pick the Fed people. If it has to be bailed out, it will be bailed out. And if it's going to cause a massive crisis, which it would, Donald Trump's not going to allow that to be on his watch. I'm getting elected twice, son. No, sir, that's not happening. So go ahead and bail it out. Keep everything afloat. Yeah. But at the same time, people would be pretty mad. Mr. President, what the hell's going on here? You know, what would he say? I've got a solution. I think we need to back the currency with gold. And at least if he starts talking about that. Yep, here we go with another bailout. The Congress, they put us all in a situation like this. Now I'm the president and I've got to fix this problem. And the only fix we can do is just keep bailing the banks out. We're going to have to do it again. But I'm going to tell you this. I've got a solution that we're going to implement on my second term. And I'm going to deal with this crisis once and for all. If he said that, we'd be like, oh. So we're going to do it again. But you got to, all right, well. All right, I mean, that's probably how that would go. It will require central banks to create yet more money, additional to that required to finance escalating government budget deficits. Monetary chaos promises to be greater than anything seen heretofore. and it will engulf all Western welfare-dependent economies and those that trade with them. We have established that between keeping governments financed, bailing out banks, and perhaps investing in renewable green energy, the issuance of new money in 2020 will in all probability be unprecedented, greater than anything seen so far. It will lead to a feature of the crisis, which may have already started, and that is an increase in borrowing costs forced by markets onto central banks and their governments. The yield on 10-year U.S. Treasuries is already on the rise, as shown in Figure 3. Now, granted, I'll tell you about Figure 3. It's between 1.75 and 2%. Around July or so, or August of 2018, it was up to 3.25%. So yeah, okay, it's back up again, but can it go back down? Again, Donald Trump might say, no, we're not doing that. Assuming no, especially when we have our own banks buying them, and then the Fed buying them from the banks so that it can stay true to its mandate that it can't directly buy from the federal government, the Treasury. I'll just buy from the bank. So banks, you buy it. 3 days later, I buy it from you. That's what they've actually been doing. We'll just keep doing it. We don't need to raise these interest rates. No need to. For other countries to step in, no, they've already stopped stepping in. That's why our own banks are doing this now with the Fed. So assuming no significant increase in the rate of savings and despite all attempts to suppress the evidence, the acceleration in the rate of monetary inflation will eventually lead to runaway increases in the general level of prices measured in dollars. As Milton Friedman put it, inflation of prices is always and everywhere a monetary phenomenon. Through QE, central banks believe they can contain the cost of government funding by setting rates. What they do not seem to realize is that while to a borrower, interest is a cost to set against income, to a lender, it reflects time preference, which is the difference between current possession, in this case of cash dollars, and possession at a future date. Unless and until the Fed realizes and addresses the time preference problem, the dollar will lose purchasing power. Not only will it be sold in foreign exchanges, but depositors will move to minimize their balances and creditors their ownership of debt. If, as it appears in Figure 3, what I just talked about, dollar bond yields are beginning a rising trend, again, because maybe they are, it's not going to turn around and they'll just keep rising, maybe that's true. The inexorable pull of time preference is already beginning to apply, and further rises in bond yields will imperil government financing. The Congressional Budget Office assumes the average interest rate on debt held by the public will be 2.5% for the next 3 years, and that net interest in fiscal 2020 will be $390 billion. That's $390 billion of your hard-earned tax money going to random people and companies and banks across the world for letting us borrow our own money. You get that? You catch that? Yeah. And that being about 38% of the projected deficit of $1 trillion. Combining the additional consequences for government finances of a recession with higher bond yields than the CBO expects would actually be disastrous. Clearly, in these circumstances, the Fed will do everything in its power to stop markets setting the cost of government borrowing. But we have been there before. The similarities between the situation for the dollar today and the deterioration of British government finances in the early to mid-1970s are remarkable. They resulted in multiple funding crises and an eventual bailout from the IMF. Except today, there can be no IMF bailout for the U.S. and the dollar, because the bailer gets its currency from the bailee. But again, these crises have always been man-made by these criminal organization bankers, elitists. It's what they've done. It's how they operate. And then they give you a story. Well, this is what happened. And you guys overborrowed. It's your fault. You borrowed. Your government borrowed too much money. So then everything crashes. We got to do a bailout. And again, they just get richer and richer and richer. And we always pay the tab. We have a man in office in our presidency, the president, who is not down with that system. So quite possibly some of these things I'm telling you about right now may not matter. Yet it still resonates with me because we do have history of this stuff happening. The question is, have they always been by the elite, or were some of them just natural? Governments just spend too much, and that's that. Maybe one, maybe both, a little bit of both, some of both. No. So some of this may not happen, may not quite be accurate, but some of it might. And what if it only takes some of it being right for the same damn thing he's talking about to happen? That's why I'm continuing on reading this, okay? Nearly 50 years ago, the UK gold rose from under £15 per ounce in 1970 to $80 in December of 1974. The peak of the credit cycle was at the end of 1971, when the 10-year gilt yield to maturity was 7%. By December 1974, the stock market had crashed, a banking crisis had followed, price inflation was well into double figures, and the 10-year gilt yield to maturity had risen over 16%. History rhymes, as they say, but for historians, the parallels between the outlook for the dollar and U.S. Treasury funding costs at the beginning of 2020 and what transpired for the British economy followed the Barbour boom of 1970 to 71 are too close to ignore. It is the same background for the relationship between gold and fiat currencies for 2020 and the few years that follow. Next section, gold and rising interest rates. Received investment wisdom is that rising interest rates are bad for the gold price. And again, imagine if we go negative in this country like Donald Trump wants. That means gold should go higher, huh? So, as I said, received investment wisdom is that rising interest rates are bad for the gold price because gold has no yield. Yet, experience repeatedly contradicts it. Anyone who remembers investing in UK gilts at a 7% yield in December of 1971 only to see prices collapse to a yield of over 16%, while gold rose from £15 to 80 to an ounce over the 3 years following should attest otherwise. So what you're saying is interest rates can rise and gold can rise. But typically when interest rates drop, gold rises anyways. Sounds good to me. Part of the error is to believe that gold has no yield. This is only true of gold held as cash and for non-monetary usage. As money, it is loaned and borrowed, just like any other form of money. Monetary gold has its own time preference, as do government currencies. In the absence of state intervention, time preferences for gold and government currencies are set by their prospective users, bearing in mind that characteristics special to each. It is not a subject for simple arbitrage, selling gold and buying government money to gain the interest differential, because the spread reflects important differences which cannot be ignored. It is like shorting Swiss francs and buying dollars in the belief there is no currency risk. The principal variable between the time preferences of gold and a government currency is the difference between an established form of money derived from the collective preferences of its users, for which there is no issue or risk, and state-issued currency, which becomes an instrument of funding by means of its debasement. The time preference of gold will obviously vary depending on lending risks, which is an addition to an originary rate, but it is considerably more stable than the time preference of a fiat currency. Gold's interest rate stability is illustrated in Figure 4, which covers the period of the gold standard from the Bank Charter Act of 1844 to before the First World War, during which the gold standard was properly implemented. With the exception of uncontrolled bank credit, sterling operated as a gold substitute. Admittedly, due to problems created by the cycle of bank credit, these year-end values conceal some significant fluctuations, such as the time the over-end gurney collapsed in 1866 when borrowing rates spiked to 10%. The depression following the Barings crisis of 1890 stalled credit demand, which is evident from the chart. However, wholesale borrowing rates, which were effectively the cost of borrowing in gold, were otherwise remarkably stable, varying between 2 to 3.5%. Some of this variation can be ascribed to changing perceptions of general borrower risk, and some to changes in industrial investment demand related to the cycle of bank credit. Compare this with dollar interest rates since 1971, when the dollar had suspended the remaining fig leaf of gold backing, which is shown in Figure 5, for the decade following. In February 1972, the Fed funds rate was 3.29%, rising eventually to over 19% in January 1981. At the same time, gold rose from $46 to a high of $843 at the morning fix on 21st January 1980, taking gold's originary interest rate as approximately 2%. It required a 17% interest rate penalty to dissuade people from hoarding gold and to hold on to dollars instead. In 1971, U.S. government debt stood at 35% of GDP, and in 1981, it stood at 31%. The U.S. government ran a budget surplus of the decade sufficient to absorb the rising interest cost on its T-bill obligations and any new Treasury funding. America enters 2020 with a debt-to-GDP ratio of over 100%. Higher interest rates are therefore not a policy option, and the U.S. government and the dollar are ensnared in a debt trap from which the dollar is unlikely to recover. The seeds of the dollar destruction were sown over 50 years ago when the London Gold Pool was formed, whereby central banks committed to help the U.S. maintain its price at $35 an ounce, being forced to do so because the U.S. could no longer suppress the gold price on its own. And with good reason for that. Figure 6 shows how the last 50 years have eroded the purchasing power of the four major currencies since the gold pool failed. Over the last 50 years, the yen has lost over 92%, the dollar 97.6%, the euro and its earlier components 98.2%, and the sterling at the most 98.7%. And now we are about to embark on the greatest increase of global monetary inflation ever seen. The market for physical gold. In recent years, demand for physical gold has been strong. Chinese and Indian private sector buyers have to date respectively accumulated an estimated 17,000 tons based on deliveries from Shanghai Gold Exchange vaults, and about 24,000 tons, according to WGC Director, whatever he's put on the PR quoted in India's Financial Express last May. It is generally thought that higher prices for gold will deter future demand from these sources, with the vast bulk of it being categorized as simply jewelry. But this is a Western view based on a belief in objective values for government currencies and subjective prices for gold. It ignores the fact that for Asians, it is gold that has the objective value. In Asia, gold jewelry is acquired as a store of value to avoid the depreciation of government currency, hoarded as a central component of a family's long-term wealth accumulation. Therefore, there is no certainty higher prices will compromise Asian demand. Indeed, demand has not been undermined in India, with the price rising from R300 an ounce to over R100,000 today since the London gold pool failed, and that's despite all the government disincentives and even bans from buying gold. Additionally, since 2008, central banks have accumulated over 4,400 tons to increase their official reserves to 34,500 tons. The central banks most active in the gold market are Asian, and increasingly the East and Central Europeans. There are two threads to this development. First, there is a geopolitical element, with Russia replacing reserve dollars, US dollars, for gold, and China having deliberately moved to control global physical delivery markets. And second, there is evidence of concern among the Europeans that the dollar's role as the reserve currency of the world is either being compromised or no longer fit for a changing world. Furthermore, the rising power of Asia's two hegemons continue to drive over 2/3 of the world's population away from the dollar and towards gold. Gold Money estimates, which goldmoney.com, Gold Money estimates that roughly 180,000 tons of gold above ground, much of which cannot be categorized as monetary. Monetary, not as defined for the purposes of customs reporting, but in the wider sense to include all bars, coins, and pure jewelry, gold jewelry, accumulated for its long-term wealth benefits through good and bad times. Annual mine production adds 3,000 to 3,500 tons, giving a stock-to-flow ratio of over 50 times. Put another way, the annual increase in the gold quantity is similar to the growth in the world's population, imparting great stability as a medium of exchange. These qualities stand in contrast to the increasingly certain acceleration of fiat currency debasement over the next few years, excuse me. Anyone prepared to stand back from the financial coalface can easily see where the relationship between gold and fiat currencies is going. Most of the world's population is moving away from the established fiat regime towards gold as a store of value, their own fiat currencies lacking sufficient credibility to act as a dollar alternative. And financial markets immersed in the fiat regime have very little physical gold in possession. Instead, where it is now perceived that there is a risk of missing out on a rise in the gold price, investors have begun accumulating in greater quantities the paper alternatives to physical gold: ETFs, futures, options, forward contracts, and mining shares. I'm going to skip a little section here. A two-step future for the gold price. It has been evident for some time that the world of fiat currencies has been drifting into ever greater difficulties of far greater magnitude than can be contained by spinning a few thousand tons of gold back and forth on COMEX and in London. That appears to be the lesson to be drawn from the inability of a massive increase in open interest on COMEX to contain a rising gold price. It will take a substantial upward shift in the gold price to appraise Western financial markets of this reality. In combination with systemic strains increasing, a gold price of over $2,000 may do the trick. Professional investors will have found themselves wrong-footed, underinvested in ETFs, gold mines, and regulated derivatives, in which case their gold demand is likely to drive one or more bullion houses into considerable difficulties. We might call this the first step in a two-step monetary future. The extent of which gold prices rise could be substantial, but assuming the immediate crisis itself passes, banks have been bailed in or out, and QE accelerated in an attempt to put a lid on government bond yields, then the gold price might be deemed to have risen too far and due for a correction. But then there will be the prospect of an accelerating loss of purchasing power for fiat currencies as a result of the monetary inflation. And that will drive the second step, as investors realize that what they are seeing is not a rising gold price, but a fiat currency collapse. The high levels of government debt today in the three major jurisdictions appear to almost guarantee this outcome. The amounts involved are so large that today's paper gold suppression scheme is likely to be too small in comparison and cannot stop it happening. The effect on currency purchasing powers will then be beyond question. Monetary authorities will be clueless in their response because they have all bought into a form of economics that puts what will happen beyond their understanding. As noted above, the path to a financial crisis for fiat currencies might have already started, with the failure by the establishment to suppress the gold price through the creation of an extra 100,000 COMEX contracts, by the way. And this time, it didn't cause the price to go down. If not, then any success by the monetary authorities to reassert control is likely to be temporary. Perhaps we are already beginning to see the fiat currency system beginning to unravel, in which case those that insist gold is not money will find themselves impoverished. This is a reason I've never, ever wanted to sell my silver. Like I said, if Litecoin got under $100, man, I think I might have to sell those silver and grab some more. It's been in the 40s for a little while now, hasn't it? And I still refuse to sell it. I'd just rather go dip in the bank account and buy some more. I want to get rid of my silver, man. But I was thinking, like I said in a video maybe it was a day or two ago, about, man, I'd love to take my family to the Southwest. Maybe we could buy this we're going there in a week. You know, me and my buddy and our two daughters. There's a house for sale. I'm looking at it. Like, it's a manufactured home on an acre. Okay. Super, super cheap. And I'm like, well, what if I did scrape a little bit of silver, little bit of cash out of the account, little bit of cryptocurrency. That way I'm not taking too much cryptocurrency, too much out of my silver, too much out of the bank account. And if that little airplane trike wing I had sold, oh, that'd be even better. If I got a call, the next few days, hey, Joe, he wants it. He's coming in tomorrow with the cash. Oh, are you kidding me? Talk about perfect timing. That would be unbelievable. That'd be awesome. So, you know, we'll see how that goes. That's my own personal thing. But again, 1 year, 2 years, 5 years, WebBot, $600 silver was coming, thousands of dollars gold. If this week, right now, Monday, Tuesday, Wednesday, Thursday, Friday, we don't see a pullback of noticeable proportions, not just a small little, you know, like they nailed it. Oh, silver 1750, boom, back down to 1415. Oh, I'm talking, oh, silver's 18, went down to 1750. Oh, well, that's nothing. Oh, it's back up again. Oh, it's back over. Oh, so $19 now. You know, what's this week going to look like? If we're on a trend here of an uptrend and it keeps going, we start to break like $20 silver. Something's going on here. Anyways, I got to go. Almost an hour-long video, but I had to do that. I've just felt people need to hear that. Take care.